committed to deliver our growth guidance on a full fiscal year basis. On the cost side, our key ingredient, extra neutral alcohol, remains inflationary, while the rest of the commodity portfolio is stable. We have delivered on our margin aspirations by successfully countering inflation through efficiencies across the value chain and revenue growth management initiatives. A quick update on the policy front. During the period, new excise policies were released across North, Central and Eastern states. We have received some headline pricing in a few states. New policy in our home state, Karnataka, has suggested slab changes with reduction of duty, which is a positive development. However, at this stage, rollout of the new policy is put on hold as the industry awaits some clarification. Industry body is also in discussion with the state and making necessary representations for seamless execution. We hope this change will help revive demand within the state and enable some premiumization of the spirits category, which is currently highly skewed towards the lower end. As all of you will recall, about a year back in July 2023, we saw some duty hikes in Karnataka, which had put tremendous pressure on demand in an already inflationary environment. In that context also, we are happy with the recent announcement. I'm also sure that you have been hearing about a state intending to open for business again. At this stage, we remain cautiously optimistic and are waiting for the new policy announcement. We are also gearing up our preparation to recommence business in the state as and when the new policy enables the same. Briefly now on key portfolio updates. Starting with our IMFL upper prestige segment, we continue to make steady progress with our brands in this segment. Our antiquity trademark continues to build stronger equity with the consumer. Post-renovation, we have conducted a very nice activation on a photography challenge powered by Antiquity Natural Mineral Water. The coastal bird heron on the label represents grace, elegance. It embodies the spirit of fearless exploration and limitless possibility. The initiative featured 8 talented artists and had the honor of jury members Satyam Bhuyan and Naveen Vatsa. The campaign engaged around 140,000 people and culminated in a stunning digital magazine cherished by the community. Within the upper prestige segment, Royal Challenge American Pride continued to outpace the segment. We launched the first of its kind 375 ml pack in the hipster format for Royal Challenge American Pride across key markets of Uttar Pradesh, Telangana and Assam. From a consumer lens, we continued the Ride with Pride activation, which was done across all key markets over the last quarter. Coming now to mid-prestige, Royal Challenge has been winning share of mind by challenging status quo with RC's distinct persona. We have reignited our television presence with a Scale 360 campaign, our first in 4 years, achieving a remarkable 65% plus reach. This campaign extended across 70 plus television channels, 1,200 plus cinema screens, and included 30 plus front page newspaper ads. We have scaled Choose Gold 2.0 through the above mentioned media and launched a limited edition product, RC Play, for the cricket season. As a limited offering, beer-flavored whiskey, RC Play was launched in the key markets of Maharashtra, Assam, Madhya Pradesh, Goa and Uttar Pradesh. Coming now to McDowell's number 1. In the current quarter, we focused on scaling the Yaro Wali Baat campaign featuring our brand ambassador, Kartik Aaryan. The campaign continued with a strong presence on digital, print in key markets like Assam, and in UP, we launched a renovated McDowell's number 1 whiskey with the new brand world and retail toolkit being deployed. Coming now to the new launches under the McDowell trademark X Series. This range includes a wide range of whites, including vodka, gin, citron rum, as well as dark rum, that will operate in the upper prestige price segment. This is a huge step in our premiumization journey of the overall portfolio, as well as our anchor trademark. Our initial consumer and trade response is very encouraging. The X Series will scale up to more markets with a target for national distribution. Coming to premium and luxury, one of the highlights from Johnnie Walker was our partnership with the Euro Cup 2024 as we dialed up our presence in impact properties to reach our target audience. We also scaled up our experientials in Blue Label with our exquisite dinners across key markets of Delhi, Mumbai, Bangalore and Hyderabad. We are also scaling up Godawan in the northern states and have anchored premium visibility for the brand at top outlets. We aim to further accelerate momentum with continued omni-channel engagement. The tequila category is continuing to see good momentum. Don Julio initial response is good with robust consumer traction and scale up across states. Premiumization within the trademark is also visible, with Don Julio Reposado growing faster than the entry variant Blanco. Consumers also prefer Reposado as the meat serve versus Blanco, which is mostly consumed as a cocktail in the on-trade. Don Julio has done some significant activations in the quarter, partners with Culinary Culture, Marriott Bonvoy and American Express to get the world #1 restaurant Central from Lima, Peru to India. This is the first time a reigning world #1 restaurant has come to India, and Don Julio was the proud exclusive spirits partner, reaching out to 100 plus exclusive guests who bought this experience at a super premium ticket price. As you know also, in our portfolio, Royal Challengers Bangalore men's team, they've significantly moved up the rank in the current season of Indian Premier League. And it is a delight to see both our women and men's team performing strongly and their fan following scaling new heights. Last but not the least, in line with our strategy to add premium Indian provenance craft brands, which complement our existing portfolio, the board of directors have approved the investments in V9 Beverages Private Limited, the makers of sober, non-alcoholic beverages, and Indie Brews and Spirits, makers of coffee liqueur. Our strategic minority stake in both the companies is a step forward in our mission to strengthen our portfolio by partnering with breakthrough startup entrepreneurs and offering our consumers a wider choice of brands. Both are early stage investments for us. You can find more details in the announcements made to Stock Exchange last evening. Looking ahead, we remain focused on harnessing the macro trend of premiumization by targeting the right consumer opportunity. Our renovation and innovation portfolio will play a critical role in this next phase of growth. We are confident to deliver our growth ambition by remaining agile in a soft demand environment and harness every profitable opportunity to create long-term value for all our stakeholders. Before I hand over to Pradeep, since the union budget was announced yesterday, here are my quick thoughts on the same. The Honorable Finance Minister of India, Srimati Nirmala Sitharaman, in the first budget speech of the current government, introduced pivotal changes in taxation and fiscal policies, emphasizing policy continuity to drive economic growth. The budget prioritizes a Viksit Bharat, focusing on tax certainty through simplified and streamlined litigation processes. Key areas include enhancing FDI, generating employment, bolstering agriculture and solar power sectors, empowering women, which is very much on our agenda, and advancing infrastructure development. A notable announcement was the FM's decision to undertake a comprehensive review of the Income Tax Act 1961 and complete it within 6 months. This initiative aims to simplify taxation, reduce litigation, and provide certainty to taxpayers. The introduction of a dispute resolution scheme is a welcome initiative that will further streamline tax litigation. Closer to our category, on the indirect taxation front, excluding extra neutral alcohol used in the manufacture of alcoholic liquor for human consumption from GST is a much needed reassurance for our industry in view of the uncertainty associated with this issue since 2017. This amendment will help in significantly reducing unwarranted tax litigation. Levying GST on ENA would have added costs for alcohol industry without a corresponding input tax credit, adversely affecting sales and tax revenue for the state. The government is also empowered to now regularize non-levy or short levy of tax due to prevalent trade practices, which is a very welcome move for us. Overall, the budget lays the groundwork for a resilient, inclusive economy, offering a forward-thinking and balanced approach to Indian economic policy. With this, I hand over the call to Pradeep for an update on the quarter's financial performance. Over to you, Pradeep.
Thank you, Veena, and a very warm welcome to all. As always, it's a delight to interact. Before calling out the quarterly financial performance highlights, we'll request all of you to refer to the results press release posted last evening. With the start of the new financial year, the results are absolutely clean in terms of basis. Hence, the terminology of rebased and reinstated has been eliminated. As Veena mentioned, we have delivered a steady quarter despite the demand environment being soft. Price mix at 4.8% was in line with a low BIO salience quarter. We have delivered an overall portfolio NFC growth of 8.3% during the quarter, within which the P&A growth stands at 10.1%. It is important to call out that a combination of two events, one a regulatory challenge in a North Indian state and another business as usual development in West, has led to a favorable growth in the current quarter that will normalize in the next quarter. It is in this context that we are requesting you to look at the first half of financial year 24-25 as one consolidated block. Our core growth drivers remain a combination of innovation renovation and driving premiumization at multiple levels to enrich price mix. As it stands today, we remain committed to deliver our growth guidance for the full fiscal year 2024-25. Gross profit for the quarter was 1,046 crores with a gross margin of 44.5%. Our marketing reinvestment rate during the quarter was 7.4% of net sales. This will step up from here as we approach the peak season of October-December to keep our virtuous growth cycle intact to drive consumer engagement in the short to medium term and to establish strong equity for our brands over the longer run. EBITDA for the quarter stands at 458 crores, a growth of 18.9% over the prior year same quarter, and EBITDA margin is at 19.5%. It is important to caveat that the margin for the quarter incorporates 100 basis benefit on account of ongoing true-up of provisions in the overhead line against two specific items. And as all of you are aware, the A&P range on the cost side, Hina has already called out. ENA remains inflationary, while the remaining input commodities are largely stable. We expect this trend to continue over the next couple of quarters. This, along with other structural cost reduction initiatives across the value chain and revenue growth management interventions, has helped us progress the margin trajectory in line with our expectations. Overall, our PAT for the quarter is 299 crores with a PAT margin of 12.7%. In conclusion, would like to say that sticking to our core strategic pillars and executing them with passion and ownership in a continuing soft demand environment currently, as well as highly inflationary periods in 2022-23, has been a key enabler to deliver our growth and margin aspirations. It also provides us the confidence in our overall business strategy and the capability of our people that remains our biggest assets and a competitive advantage. And as we look around and hear the news flow on policy front as well, we remain optimistic on the prospects of a conducive business environment and the improvement in the consumption momentum and thereby our ability to further enhance stakeholder value. With this, we can now open the floor for Q&A. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and one on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Abneesh Roy from Nuvama. Please go ahead.
Yeah, thanks and congrats on a good set of numbers in a very tough quarter. My first question is on the two M&A which you have just announced. Wanted to understand the thought process because when I see the sales in FY23 also for both companies, it's broadly quite small at 0.6 crores. But in FY24 also there is no growth. In fact, both companies seem to have seen a YOY dip on that small number. So what has made us buy this? Is it the technology? Is it the manufacturing capabilities? Plus, from a longer-term perspective, can both of these brands go much deeper into most of the states? Wanted to understand how you see distribution from longer-term perspective.
Hi, Abneesh. Thanks for the question. So, as you know, we've been following an agenda of future-backed consumer insights-led sort of innovation engine creation, right? And both these categories, which is non-alcoholic and or zero alcohol as we call it, plus liqueurs, are categories that we do look at growing in the future. They have some traction and they are categories that we expect will gain much more traction. And therefore our investment is very early stage investment to create future engines of growth. these are small entrepreneurs, and clearly, as one of the objectives and goals that we have identified is not only to operate in, local craft, premium craft, but also help the craft ecosystem to grow. So clearly, with Diageo's scale and support in terms of technology enhancements, in terms of the distribution might, these are categories that we definitely see will have the potential to scale up, to grow, and become national in the future. So, and what we look for is the culture and a culture fit of the founder and the quality of the product, which both ranges are very high quality. So this is in anticipation of creating a new growth engine based on future back assessment of where the consumer is headed.
Understood. My second question will be on the excellent margin delivery you have done this quarter. So when I see the other cost, there is a very good control both quarter-on-quarter and YOY. So is there any one-off here because such a sharp control here? Is this sustainable? I understand Q1 elections were there, and generally it is a weak quarter. So how easy will it be to have this kind of a cost control in rest of the 3 quarters?
CJ, can you take that question, please?
Yeah, no, thanks, Abneesh. And I did kind of refer to it in my opening comments, right? So on a quarter basis, as I mentioned in my opening comments, there are certain true-ups of provisions, right, which for the quarter are giving us 100 basis points benefit in our EBITDA margin, right? So if you normalize for that, the 19.5 should be read as 18.5, and then you are well aware of the A&P, which is the lowest in this quarter. Once you normalize that, we are back in that 16 and a half kind of a range, right? Now, I will look at it positively because that gives us the confidence that we are pretty much in a position to continue to expand the margin trajectory a little bit from where we ended last year. So we are in good shape. I think that's the way I look at it. Why I have called this out, Abneesh, is so that you guys don't end up extrapolating this quarter, right? The number is material for the quarter. If you look at it on a full year basis, these are absolutely business as usual items, but it's just because of the quarterly timing, they tend to kind of come up in different quarters. Therefore, we just thought it in terms of transparency, I need to call it out. Hope that helps.
Understood. My last quick question. So, Hina, in your initial remarks, you said FY25 also will be a story of 2 halves, and you rightfully had called out slowdown around 1 year back. What is giving the confidence of further acceleration? You're already doing a good growth in terms of volume and sales, both in PMA. In second half, the optimism, is it largely because of base effect? Because overall, still there is no big change in other discretionary categories when we see pizza or apparel or footwear. Most of the other discretionary categories still things are quite challenging. So it will be mostly marriage season coming back. It will be the base effect catching up.
So, Abneesh, I think it is base effect, right? I mean, last year we were very high growth quarters in the first 2, and then there was a slowdown in the next 2, right? And this year we are kind of seeing the results, right? So we are expecting the first half to be, maybe very muted, lower than our aspiration, but overall for the year, we are sticking to our guidance. There is hope that consumption will pick up this season, right? And there is also the scale up of some of our innovations and renovations, which will really dial up as we go along the year. McDowell's X series, for instance, with our range of vodka, rum and gin, right? We expect to tend to national distribution. And, we've got Johnny Walker Blonde, we've got Royal Challenge American Pride still scaling up. So it is a question of base effect, plus the fact that we will have national rollout of our innovation and renovation portfolio.
Sure, thanks. That's all from my side. Thanks.
Thank you very much.
Thank you. The next question is from the line of Avi Mehta from Macquarie. Please go ahead.
Hi, Hina and Pradeep. Hi, Pradeep. Pradeep, I actually wanted to just pick up on one comment that you made in the initial comments about some benefits on Northeast and West India. Could you clarify what exactly was it? And I'll kind of get to the question then. I didn't quite understand them, so it would be useful if you could clarify them, please.
Yeah, so what we want to share was that, look, based on what we have experienced in April, June, right, we have experienced a certain momentum in one of the western states, right? We have probably a handle on it as to why, right? And therefore we see some amount of the growth for the first half getting front-loaded in the first quarter, right? Which is likely to normalize in the second quarter. And therefore, I think Hina also mentioned in her comments, and I also mentioned that it is again our recommendation that you guys don't extrapolate these numbers, right? And look at the first half, which is April to September, as a consolidated block, right? So that's what I would want to share at this point of time.
Okay. Is it possible to give us a sense on what, I mean, I'm not sure if you can give us some quantum or some way to understand how much would this benefit be, or?
I mean, like I said, it's business as usual. Therefore, it's difficult to quantify that in this vast kind of, deep and wide business. But we know that there is a certain amount of, benefit that we've got in the current quarter.
So, okay, let me rephrase this, Pradeep, and where I'm coming from is the fourth quarter you had cited concerns on demand, and I mean this 10% growth is pretty good in that context. Now I understand there is some one-off aspect, but if I look at the first half and the second half, and given our target of 10% plus double-digit growth in FY25, the way I should see this, and please clarify, its first half should be closer to that 10%, it will be ahead of. Is that how you're seeing this? Could you give us some sense on how should we look at growth rate from a sales perspective? Would be helpful.
Oh, absolutely. So let me help on that. And that I think is pretty much called out, Avi, as you had mentioned. It will be exactly a story of two halves. Only the growth will change in the halves, right? So therefore, I can go on record and say that first half will be less than double digits, right? And the second half will be higher than double digits. As of now, we stand absolutely committed, right? That on a full year basis, we should be on our double digit guidance.
Got it. Perfect. Very helpful, Pradeep, and thanks a lot for sharing, being transparent in these disclosures. The other bit I just wanted to understand is on, I got your 100 basis impact in provision. Is this something that is changes in the next quarter, or no? This is something that has happened, and now from here on, whatever number I kind of grew up based on will continue going forward. And the related question is or actually more importantly, is the gross margin. Is there any one-off in the gross margin, because that moved up quite sharply on a sequential basis, and I wasn't sure if we can take that number as a steady state, because ENA costs seem to have flatlined, but we'd love to hear on that part, please.
No, fair. So I think, on the first question of yours, Avi, my response will be same as what I've provided to Abneesh, right? So there is no one-off, right? These are pretty much in the normal course, right? But on a full year basis, right? And, when these trigger events happen, etc., and your, provisions get trued up in the quarter, because the period is so small, right? The numbers become material. So therefore, I do want to call that out, right? The 100 bits, right? Because I know how you guys run your models. The 19.5 becomes base, and then from there onwards, right? So I kind of worry on that front. So therefore, I'm calling it out. But on a full year basis, these were absolutely par for the course and normal, absolutely normalized items. So yes, our sharp answer to your question is, do not extrapolate our current quarter margins on the overheads line. Absolutely. That's one. Your second question on growth margin, you're right. Look, I will only say, Avi, that, we are fairly refined in dynamically allocating our growth driver resources, right? So, and look, there are two big growth driver streams, right? There is A&P, and there is obviously the trade spend, right? Both are equal, but one is above the gross margin line, one is below the gross margin line, right? And depending on the tactics you have for a quarter or for a particular month also at times, right? There could be dynamic allocation between the two, right? So I think that's broadly what has happened. That's why you see the A&P a little higher. We have done that, and because we kind of reduced our trade spending, that provides a kicker to our gross margin. But yes, you're right. There is absolutely nothing sustained in the gross margin that has happened in the quarter.
Got it. And just a last bit, if I may, this Karnataka bit. by when do we expect clarity? I was under the understanding that it's beneficial from a premiumization perspective. But given Karnataka is a popular heavy market, I would like to know how should we read this change. Thank you.
Yeah, no, absolutely. Hina, you want to take that or?
Yeah. So, Avi, we are in touch with obviously the relevant government officials as an industry. We do expect that sometime in August we will get more clarity and business should resume as usual. As I mentioned in my opening, we do expect to see some premiumization in the state. It is a positive policy announcement. But I just want to say that even with the duty adjustments, the product will still remain relatively more expensive than many other markets. So, there will be some benefit of premiumization, all in the right direction, but we don't expect that it will be an explosion, right? Because the product remains still reasonably expensive.
Okay, Hina. Perfect. No, I'll come back in the queue for the other questions. Thanks a lot, and thanks for being so crystal clear and transparent on how should we read these performance.
Thank you.
Thank you.
Thank you. The next question is from the line of Latika Chopra from JP Morgan. Please go ahead.
Hi, Latika.
Hi, Latika. Hi, Hina. Thank you for the opportunity. I think some of the questions got answered. But I wanted to first check on any color that you can share with us on any kind of impact, from changes in West Bengal taxation policies.
It's still in the works.
I didn't really catch the question. Pradeep, did you?
Yeah. So I think Latika's question, Hina, is on the West Bengal excise policy. The expression of interest has come, Latika. We are still working on it, right? So a lot more clarity will emerge in the next 2 to 3 weeks, right? So right now it's too early to call anything. Yeah.
Okay. All right. The second was, out of the 5 drop in realization.
Sorry, I can't hear the question at all, Pradeep.
Latika, you're breaking a bit.
Okay, I'm sorry. Is it better?
Now it's better. Much better.
Okay. My question was, on the quarter for P&E realization were close to about 5%, on a YY basis. What would be pure pricing in your assessment in this number versus the mixed benefit?
In the current quarter?
Yes, in the current quarter or...
In the current quarter, I'm just kind of, thinking of the shelf, Latika. I think our P&A volume is at 5.1 if I'm not wrong, and total NSV is 10.1. So the breakup of the balance 5 would broadly be about, I would say, it's about 1.6% of pricing and the balance is mixed.
And Pradeep, would you expect the pricing part to keep improving depending on, what are your sensing on, this realization or price mix ending up in the remaining part of the year, considering whatever you have knowledge on, different policies, that are playing around, plus of course your own continued initiatives, that you see on driving premiumization.
Yeah. So look, Latika, Hina and I have maintained a consistent stand on this, right? We don't want to get into a breakup of the two, but price mix as a whole, the volume value delta, right? We've always maintained, and actually we took this position 2 years ago when BIO was very, very buoyant. But yeah, I'll probably go ahead and still kind of put ourselves on the neck, which is that it will stay in the range of about 6 to 8% on a full year basis. Again, there might be quarterly vagaries, right? But I guess, on the lower end, 6%, on a higher end, 8%, etc., that will probably stay, right? So that's what we will probably hold ourselves. And this I'm kind of talking P&A, right? So P&A price mix will remain in the 6 to 8% range, and that's what we will probably sign up for. The breakup between headline pricing and mix could vary, right? We've had pretty good 24 months, I would say, on headline pricing, even though nowhere near the inflation levels, but can't complain compared to our historical run rates. So probably the headline pricing will moderate a little bit, but we continue to remain very, very focused on our optimization and driving the realization through that.
This is useful. And absolutely the last question, Hina, your opening remarks. You started off with, green shoots in, rural, right? Just wanted to understand a bit better, is the portfolio skewed, or what salience of the portfolio is skewed towards smaller cities? Is that what you're calling for? Some bit of an update, possibly in popular and lower prestige? That was one part that I wanted to understand.
Right.
The second bit was just checking, are you sensing any kind of moderation risk on growth in any of your urban centers or, urban consumption at the same time? That's all.
Right. So on the green shoots, it was more a general comment, Latika, on the sort of economy, right? And as rural economy improves, monsoon, I think the overall sentiment improves. And we don't see a direct consumption impact, though at the lower level there will be some, right? But it is more about the sentiment of the economy and therefore the consumer sentiment hopefully leading to more demand, right? On the moderation risk, I have been calling out for 2-3 years now that consumers, we do see, and this is not state specific or town specific, we do see consumers saying that they don't want to drink more, they want to drink better, right? And that is only getting, I think, sort of accentuated with the newer consumer coming into legal drinking age. And therefore, our story of robust sort of premiumization and expectation of robust premiumization trends as we look forward is based on. And I would say that overall, Latika, still I would say that, look, I mean, penetration still remains quite low in the country. Per capita still remains quite low in the country. So if I just look at enhanced penetration, if I look at, consumption, and if I look at premiumization and the desire to continue to start adopting better products, that bears really well for us as an industry.
Understood. Very clear. Thank you so much, Hina and Pradeep.
Thanks.
Thank you, Latika.
Thank you. The next question is from the line of Jay Doshi from Kotak. Please go ahead.
Hi, Jay.
Hi. Thanks for the opportunity.
Hi, Jay.
Hi, Hina. Hi, Pradeep. So you have delivered, consistent gross margin improvement over the last 4 to 6 quarters, notwithstanding, inflationary environment, especially in ENA. So I just want to understand, what benefits of the cost-saving initiatives you undertook about 2 years, 1.5 years back, which is mono-carton elimination and then supply agility program. What percentage, where are you in that journey and how much more headroom we have? I'm assuming that those benefits are essentially helping gross margins or, helping you mitigate inflationary pressure.
Yeah. Maybe, Hina, I can take that, right?
Yeah, please. Yeah.
So, Jay, I think as we mentioned in the last call also, the mono-carton is fully in the P&L now. Absolutely, right? Completely in the P&L. And you're right. I mean, our last year, if you look at the financial year 2023-24, the big bump up on productivity that we shared in the May annual investor call as well, right, was largely driven by the mono-carton initiative, right? That was roughly worth around, I think, 160 to 170 crores on an annualized basis, right? So that's all fully into the P&L. And therefore, the productivity numbers, will moderate compared to 2023-24, right? But hopefully the good thing is that inflation is also kind of moderated a little, right? So that should that should keep us in good stead, right? Sorry, I've kind of missed your second question.
Supply agility program.
Supply agility, right? We had shared a status update again in the May call, and you could refer to that. We had said, I think 40% of our stated benefits, right, of the full program were already in the P&L by March 31st, right? And the balance 60% will kind of come in a piecemeal manner. I think we had mentioned when we announced the program that the full program benefits will be into the P&L only by financial year 2027-28, right? So So, I mean, in a way, we are pretty good actually, 40% already in, right? But obviously the tougher ones are now kind of, being queued up, and they will take a little while to come into the field.
So at this point of time, it looks like you're directionally or comfortable on gross margins, right? There is no incremental headwind per se. If at all, gradually it could get better, a little better, right?
Yeah, I mean, see, right now it's a balancing, right? ENA remains awfully inflationary, right? And, pardon my use of word on that, right? But it's being balanced completely by the entire rest of the commodity portfolio, right? So therefore, it's pretty much, one input kind of inflating at a very rapid pace, and everything else kind of, neutralizing it, right? So that's a good place to be in, I would say, and probably this trend will stay for the next couple of quarters at least, right? And then once the new crop comes sometime in December, etc., then we'll have to probably see, how the next 2-3 quarters look like.
Sure, perfect. And last one, which I think I've asked earlier as well, if Andhra Pradesh opens up, that poses upside risk to your full year growth guidance, right?
Yeah, no, that's a tough one to call, right?
I would say I think I have said this before, Pradeep has probably said this many times before, right?
Correct.
During the course of the year, many markets open, many markets close, right? I mean, over the years, we've seen that. One market closes, one opens. So, can you factor everything as an upside? It's very difficult to say, right? Because we don't know what happens in any market next, right? So, I mean, we had the case of Delhi, which went away from the base completely. Then we, had to recover the growth from somewhere else, right? So I don't think that, we can say that everything will remain hunky-dory and Andhra will come and sit with a full layer on top. Of course, it will give us positive upside. But at this point in time, I don't think that we can say that this will end up well. Right?
Sure. Thank you so much, and wish you the very best.
Thanks.
Thank you, Jeff. Thank you.
Thank you. The next question is from the line of Percy Panthaki from IIFL Securities. Please go ahead.
Hi, Percy.
Hi, Pradeep. How are you? Hi, Hina. My question is again on the gross margin front. So you mentioned in response to an earlier question that there is some lower sort of trade spends this quarter, which has benefited the gross margin. So what I wanted to understand is this lower trade spend something structural which can continue? And just wanted to understand, basically, see, you've done 44.5% gross margin this quarter. Is that a good number to take for the remaining 3 quarters as well, or this trade spend which is lower will sort of come back and we need to take a lower number than this for the remaining 3 quarters?
No, so Percy, like I said, it's a very tactical shift for the quarter. Right? It's a very tactical shift for the quarter. Nothing structural, on trade spend. There is a set of structural interventions we anyway target, right? And that is kind of chugging off beautifully. But this kind of a shift in one quarter, this was completely tactical, right? Basically, we wanted a little more A&P for the extended cricket season, and therefore we thought, our brands are in kind of reasonably good shape, right? And we could squeeze a little from trade spend. So those are, ongoing tactics that we apply, right, as we run our book.
Understood. So basically, if the inputs remain where they are today for the rest of the year, then the gross margin would be a tad lower than what we have seen in Q1.
That's right.
Understood. Secondly, just wanted to understand your traction on the global brands which are benchmarked at that 10% EBIT margin, that entire portfolio. Over the last, let's say, 1 to 2 years, what has been the growth in that portfolio, and how do we sort of model the margin impact of that into? I mean, I understand the absolute EBITDA per case is higher, but we are already getting the benefit of that in the top line, so we also need to model in some amount of impact of that into the margin. So how do we basically go around modeling that, and any kind of pointers would help?
No,
I mean, I can talk on the board. You can talk on the modeling if you want.
Absolutely. Why don't you go ahead?
Yeah, so firstly, I think, as you heard us over the last couple of years, I mean, our global brands were growing at very strong double-digit rates, right? So, but that we have called out over the last few quarters, while premiumization ladder is still intact, the growth has moderated quite a bit, right? So there is premiumization, the growth has moderated. And, we continue to get mixed benefits, right, from it. We continue to get the uplift on absolute EBITDA, and, Pradeep can then, follow on with how do we model that and what should we take, right?
Right. Understood. And lastly, if I can just squeeze in one question, supposing the UK FTA does take place, what kind of benefits do you expect from that? So I understand theoretically there will be two benefits. Like one is on the price of the bulk scotch, which will basically be a reduction in 2 year COGS, and the second is basically making the global brands a little more affordable and pushing up their volume. But any kind of way to think about the quantum of these 2 points would sort of help.
I think we've addressed this earlier also, Percy. Let me remind you and let me remind the group, right? So, first of all, it's very difficult to say how much reduction would happen, but I just want to say conceptually, right? So it is a very small part of the value chain of our of brands, right? So, the national customs duty is a small part. The main duties are from the states, where a lot of the adjustment on duties from several states has already happened over the last 2-3 years. So, depending on where that 150 went, right? If the 150 went to 100 or 50, depending on that range, we expect that, the impact on, say, pricing would probably come down between 5 to 15% with the corresponding increase in demand, right? So that's the range. Right, and we really want you to understand this. That it is not as if Scotch will double. Firstly, there's not enough Scotch in the world to double, but
current landscape and the current regime, right? But yes, I do want to assure you, the number, let's say the 150 comes down to about 100 or 75, the number will be, it'll be upwards of, 50 to 70.
Okay. Thanks very much. That's all from me. Thanks.
Thank you.
Thank you.
Thank you. The next question is from the line of Krishnan Sambamurthy from Nirmal Bang Institutional Equities. Please go ahead.
Hi. Yeah, hi. Two questions. One is, what exactly is the clarity that you are seeking from the Karnataka government on the tax slab revision?
The associations are in discussion. There are a couple of clauses which the industry thought were a little regressive, right? And therefore the discussion is all around that. As we have already mentioned in her opening comments, overall the direction is very, very positive in terms of reducing the duties on the higher end of the portfolio, which kind of enables the state to premiumize the category and hopefully drive more exchequer revenue while giving the consumers an option to drink better, right? But there are a couple of other minor clauses which are a little regressive. I think that's what the industry is kind of discussing right now with the government.
Understood. And second thing is on the price increases by various states. What are the incremental price increases that you have obtained in the last 3 or 4 months, and which are the states, if you can highlight that?
In the quarter or in the year?
In the quarter or over the last 3 or 4 months.
We've received price increases from a lot of states over a full year basis. Like I said earlier, right, last 2 years have been pretty good on headline pricing, right? Again, I want to caveat nowhere compared to inflation, right? But again, with our historical run rate, we have actually inched up our headline pricing realizations here. We have, in fact, you can look at our last 2 years annual investor call presentations. The numbers are very transparent.